What's up guys, Ben here and welcome to Motivation to Invest. Charlie Munger is one of the greatest investors of all time. He's widely known for being a great friend and business partner of Warren Buffett at Berkshire Hathaway, the world's largest investing conglomerate. Charlie Munger is one of the greatest thinkers I've ever came across in the investing field. I've read all his books and honestly, he's truly fascinating and just full of wisdom. He reminds me of the Yoda of the investing game. He's 96 years old now, but still has a great sense of humor, intelligence and philosophy on life and investing.
But even so, in the companies that you deal with, some of them are market leaders at one point in time, and as you just suggested, some technological change or change in preferences will lead those companies to be with less of a market than they used to have for their products. And so how does one think about this over the long term? Because it's
over the
an
long
interesting
term, the companies of America behave more like biology than they do anything else. In biology, all the individuals die, and so do all the species. It's just a question of time. And that's pretty well what happens in the economy too. All the things that were really great when I were young have receded enormously, and new things have come up, and some of them started to die. And that is what the long-term investment climate is. And it does make it very interesting. Look at what's died. All the department stores, all the newspapers, US Steel, John D. Rockefeller's Standard Oil, the pale shadow of his former self. It's just like biology. Or they have their little time and then they get clobbered.
And so how does one, as sort of a witness, or sort of in a certain way, one lives longer than the life of some of these companies, sort of deal with change, right? So you could think about an investment portfolio that you create at a point in time will only have validity for a certain amount of time. And so how does one learn to deal with change? It's a question that I always ask my students, and I would just, how does somebody who has to take the resources of very large numbers of people deal with change? Any thoughts on that matter?
Well, some people try to get on the cutting edge of change, so they're destroying other people instead of being destroyed themselves. And those are the Googles and the Apples and so forth. Other people like me do some of that, joining things like Apple, and in some ways we just try and avoid big change that we think is likely to hurt us. And so Berkshire, for instance, owns the Burlington Northern Railroad. You can hardly think of a more old-fashioned business than a railroad business. But who in hell's ever going to create another trunk railroad? So it's a very good asset for us. And we made that success not by conquering change, but by avoiding it. Now, Burlington Northern itself has been quite clever at adapting technology to their railroad. Imagine the good luck of being able to take an existing railroad and double deck all the trains and raise the heights of the tunnels a little and so forth. And all of a sudden you got twice the capacity at very little incremental cost, which is what that railroad has done. Everybody uses new technology, but it really helps to have a position that almost can't be taken away by technology. How else are you going to carry goods from the port of Los Angeles to Chicago, except on our railroad?
So it's innovation within an economy that continues to follow certain sets of rules rather than looking for the new economy. Is that another way one could think about it?
There are different ways. All successful investment involves trying to get into something where it's worth more than you're paying. That's what successful investment is. And there are a lot of different ways to find something that's worth more than you're paying. You can look for it right in the cutting edge of technology, the way Sequoia does. The most remarkable investment firm in America is probably Sequoia. That venture capital firm, which absolutely fanatically stays right on the cutting edge of modern technology, they've made more money than anybody, and they have the best investment record of anybody. It's perfectly amazing what Sequoia has done.
So you've also talked repeatedly about people's mental biases. As you said, you don't want to be the smartest person, but you want to avoid doing stupid things. So how does one guard against mental biases in one's decision making?
I spent a lifetime trying to avoid my own mental biases. I rub my own nose in my own mistakes. B, I try and keep it simple and fundamental as much as I can. And I like the engineering concept of a margin of safety. I'm a very blocking and tackling kind of a thinker. I just try and avoid being stupid.
So,
and I have a way of handling a lot of problems. I put them on what I call my too hard pile, and I just leave them there. I'm not trying to succeed in my too hard pile.
And do they sometimes come back and require for you to?
Oh, I sometimes get things that are too hard, and when that happens, I fail.
So one has to accept limitations. Is that one of the really important pieces of avoiding these biases?
What I would say is the single most important thing, if you want to avoid a lot of stupid errors, is knowing where you're competent and where you aren't, knowing the edge of your own competency. And that's very hard to do because the human mind naturally tries to make you think you're way smarter than you are.
So as a question that's almost personal given my research, I can't resist asking about innovation in finance. Over the last half century, it's a sector that's gone through several upheavals, radical change. To go back to the time when you were born, there were 30,000 banks in the US. None of them were very, very large. A few New York banks were big. And now the top 20 banks account for almost everything. But the range of innovation in finance has been huge. And there's a debate in academic finance for sure about how much of this innovation is helpful to the markets versus how much actually creates instability.
Well, I have a very clear opinion on that. I think the early innovation that the Bank of America did under Giannini, where he helped all these immigrants with these loans, and of all kind, and he kind of knew which ones were good for it and which ones weren't. I think that was all of the good. That brought banking to and banking helped to a lot of people that deserved it. It helped the economy, it helped everybody. But once banking got so they want to be in soft white hands and make zillions as speculators, I don't think those developments have been a plus. In other words, I like banking when they're trying to avoid losses.
Extremely disruptive to American society and to the American economy. How do you think the economy is going to emerge over the next 12 months from this period of great difficulty? And how much of the change that we've seen start to happen is going to be persistent?
My opinion on that is no better than anybody else's. I think it's quite likely that a year from now, the worst of that will be very, very thoroughly behind us. It's amazing. I watched the polio get totally killed by the vaccinations. And I think they'll spread these vaccines over the world so fast it'll make your head swim. Shrink to insignificance in the course of the next year.
And what about the transformation to retail? You said department stores are gone, but there seems to be at work a quite massive transformation of retail. Are we going to go back to Old Town Pasadena, for example, or is the shift to online retail more permanent?
I don't think retailing is going to go away. After all, it's been around for thousands of years. But certainly it's been a very difficult place to make money because of what the internet has done. Retailing has gotten very tough. And I think this online stuff is here to stay, and we'll get more and more efficient.
So that could be actually good for the consumer, but more difficult for certain sets of investors, in particular, sort of commercial real estate.
Of course, these changes are always bad for some investors and good for others. seen the full brunt of the changes that are coming in terms of this online shopping.
Well, but there's also,
I'm a director of Costco, and in the last reporting period, their online sales were up 86% over the same quarter last year. Now, that is a significant development. And is it good for other retailers? No, it's good for Costco, but it isn't good for them.
but how much of their sort of brick and mortar stores how much of this is people who would have shopped at Costco in the departments, in the stores?
Brick and mortar stores are already doing well, but their brick and mortar stores have been enormously destructive because of their low prices and efficiency to other retailers. The last thing I would want to do in retail is compete with Costco.
So we've talked a bit about retail, and the reorganization of the American labor force is also going to, you think that is going to be a more transitory phenomenon, that once we get vaccinated, the jobs are going to return? Or are we likely to see a slow return of employment in the same way that we did after 2001, 2002?
I remember that I did not make my fortune, such as it is, by predicting macroeconomic changes better than other people. What Buffett and I did was we bought things that were promising, and then sometimes we had a tailwind from the economy and sometimes we had a headwind. And either way, we just kept swimming. That's our system. And after all, that's the system Caltech has too. Caltech just gets up in the morning and keeps swimming, and pretty soon they're eminent. Caltech's not trying to play the game of getting big advantage out of the booms and busts. We're just like Caltech.
He has two questions. The first one is, he has a theory that really smart people foresee the future better than others. And so we can ask, what did you think about that? And then his second question is, did you ever make a bad business decision?
Well, the answer is the second one is, of course, I've made bad business decisions. You can't live a successful life without doing some difficult things that go wrong. That's just the nature of the game. And you wouldn't be sufficiently courageous if you tried to avoid every single reverse. And what was the first question?
Do smart people predict the future better than others?
Well, that is a very interesting question. You could argue that both ways. A lot of smart people think they're way smarter than they are, and therefore they do worse than dumb people. And if you ask me, and it's very common to be utterly brilliant and think you're way the hell smarter than you are. I think Warren and I have been pretty good at avoiding that one. We're pretty modest about how, I know how, what my mental capacity is, and it's pretty low compared to the best that could possibly be. When I was at Caltech, I took this course in thermodynamics from Homer Joe Stewart. And one thing I learned from he, by the way, a lovely human being and gifted beyond compare. And one thing I learned was that no matter how hard I would try, I could never be as good at thermodynamics as Homer Joe Stewart. And I think that is a very useful lesson. I knew what I could do and I couldn't. And I never even considered trying to compete with the Homer Joe Stewarts of the world in thermodynamics. Well, I'm a big fan of knowing the big ideas in pretty much all the disciplines, the ones that are pretty easy to assimilate, and then using those routinely in your judgments. That's just my system.
My next set of questions are more on the finance side. So Paul Goodson, who has a bachelor's degree in science in 1975, asked, do you expect the next 10 years to have lower returns in the equity markets than the last 10? He doesn't give us an idea why.
The answer is yes.
And could you give us a hint as to why that might come to pass?
Yes, because so many people are in it and the frenzy is so great and the systems of management, the reward systems are so foolish that I don't think it's going to work at all. I think the returns will go down, yes. In real terms, the returns will be lower.
So Schuler Coolin, bachelor's degree 1995, is going to ask about political economy. So two different questions. What do you think of the combinations of quantitative easing and large fiscal deficit? And where are they going to lead us?
Well, there I've got a very simple answer, and that is, it's one of the most interesting questions anybody could ask. And we're in very uncharted waters. Nobody has gotten by with the kind of money printing we're doing now for a very extended period without some trouble. And I think we're very near the edge of playing with fire.
It is remarkable how much we've expanded the money supply, how low interest rates are, and how little initial response there's been on.
Remarkable is not too strong a word. Astounding would be more like it.
I will let you choose the adjective, Charlie.
It's unbelievably extreme. Some European government borrowed money recently for some tiny little fraction of 1% for 100 years. Now that is weird.
So
What kind of a lunatic would loan money to a European government for 100 years at less than 1%?
For a lot of time, a lot of the policymaking in the world was because capital is scarce. For a long time, the world economies were poor. And since World War II, we've been creating wealth at a very, very high rate. Have the rules changed to some extent because, in some sense, the developed economies are just very wealthy?
Well, of course it's changed to some extent because the developing economies are very wealthy. It's changed enormously. In my lifetime, advanced civilization has gotten ahead faster than any century that exists before, and nothing else is even close. It's utterly without precedent in real terms. It's unbelievable. I watched the whole damn thing practically because I've lived so long. And it's been absolutely astounding. I can remember having a 5-course filet mignon dinner in Omaha for 60 cents when I was a little boy. The world has really changed.
Wealth can be high because we've accumulated a lot of wealth or because the value of that wealth is high. So David Whitner, who is an associate degree in 1975, asked, is the NASDAQ in a bubble and will it blow up? And do we know when? Is the NASDAQ in a bubble?
Well, nobody knows when bubbles are going to blow up. Just because it's NASDAQ doesn't mean it'll have another run like this one. This has been unbelievable. There's never been anything quite like it. If you stop to think about it, think what Apple is worth compared to John D. Rockefeller's oil empire. It's been the most dramatic thing that's almost ever happened in the entire world history of finance. The other thing that's really remarkable, the last 30 years of China, they have had real economic growth at a rate for 30 years that no big country has ever had before in the history of the world. And who did that? A bunch of communist Chinese. Now that is really remarkable.
So Bob Riedenthal, who has a PhD in 1979 from aeronautical engineering, asked, so how would you rate investing in China with the current political tensions? Or you invested in China through the ownership of American companies that do business in China?
Well, of course I'm invested partly in American companies that do business in China, including Coca-Cola. But I'm also invested very significantly in China through the management of Li Lu, whom the Munger family backed heavily when he formed a little private equity firm to invest in China. And he has had a very successful record, and that's made me follow very closely the leading companies in China. And of course, I've had very successful experience there. And I think it's likely to continue. No other big country ever got ahead this fast for that long.
And does that say that sort of the politics don't matter so much, or?
Yeah, it does. That's a very interesting observation. What that shows is exactly right. Who would have guessed that a bunch of communist Chinese run by one party would have the best economic record that the world has ever seen? Of course it's extreme. And I think it proves that, it doesn't, we Americans would like to think that our free expression and allowing all kinds of opinion and all kinds of criticism of the government is totally essential part of the economy. And what the Chinese have proved is you can have a screamingly successful economy with a fairly controlling government. A big amount of self-awareness and how much you know and how much you don't know. You have to know the edge of your own competency. And a lot of brilliant people are no good at knowing the edge of their own competency. They think they're way smarter than they are. And of course, that's dangerous and causes trouble. So I think Caltech would have a hard time teaching everybody to be a great investor.
Srivasan Prakash asks, I'm 16. I want to take up investing as a full-time career. What is Mr. Munger's best advice for me?
If you pursue any career with enough fanaticism, that's very likely to work better than not having the fanaticism. And so if you look at Warren Buffett, he had this fanatic interest in investments from an early age, and he kept making small investments, even with his paper out savings and so forth. And he finally learned how to be pretty good at it. And if you want to succeed in investments, start early and try hard and keep doing it. That's all success comes that way, but by and large.
Warren Buffett says the greatest investment you can make is in yourself, because no one can take your own talents, your own knowledge, your own abilities away from you. So if you guys actually want to learn more about true financial education in terms of investing, stocks, etc., still haven't subscribed yet, what are you waiting for? Go ahead and hit that subscribe button. Join the investing family and turn that notification bell on. If you want more investing tips and exclusive stock market picks, which I'm personally investing into. With that being said, I hope you guys have a tremendous day, and I'll see you in my next video. Invest safe.